Foot Locker shares slipping this morning as you're seeing shares down by 27% under pressure on its quarterly results here. Despite beating the street's expectations on the top and bottom line, the footwear retailer forecasting weaker full-year guidance and pushing back financial targets. CEO Mary Dillon outlined last year. For more, we're joined by Janine Stichter, who is the BTIG Consumer, Retail and Lifestyle Brands Analyst. Plus, we've got Tom Nikic, who is the Wedbush Securities Senior Equity Research Analyst for Apparel and Footwear. Great to have you both here with us. First and foremost, Janine, got to go to you on this one. You see a report like this come across, the outlook a little sketchy, perhaps, and we're taking a look at shares moving down 27%. What's the street latching on to here from your perspective?
Yeah, I think it's all in the context of the go-forward outlook. I mean, for some perspective here, this is a stock that rose significantly into earnings. From a valuation standpoint, was trading well above historical averages. So you had high expectations into the print. And I think they met that for Q4. But the challenge is really the go-forward outlook, which you mentioned came in significantly below consensus. And when you break it down with the color they gave on the call, a lot of that improvement that they're expecting is really in the back half of 2024. So we're not getting immediate improvement. The first half of the year numbers need to come down. And then as we think about their 28 outlook that they're pushing out 2 years, a lot of that improvement is also going to come in 2026 through 2028. So we're really not getting the improvement that we would have expected. It's all taking more of a delay than we would have thought coming into the sprint.
Tom, the strategy that is taking place right now, sacrificing margins, at least in the most recent quarter here, in order to clear some of that excess inventory, is that a strategy that makes sense? And is it one that we could then expect going forward, given that they are a little bit more behind than initially thought in this turnaround story?
Yeah, I mean, look, like they very clearly had too much inventory. I mean, you would walk through the stores during the holiday season, and I've never felt as claustrophobic in a Foot Locker store as I did walking through the stores in November and December. So it made perfect sense for them to try to get their inventory cleaner. I think one of the issues, and this alludes to what Janine said about the back half weighted guidance, they're also assuming that sales trends will get better as the year goes on, as they start discounting less and less. That is somewhat of a risky proposition because consumers like discounts, and when you train a consumer to look for discounts, it can be very difficult to rip that Band-Aid off. So I think that's another reason why you see the stock under so much pressure today.
Tom, just to follow up on that, and I will add that my own visits and Yahoo Finance informal channel checks to the stores revealed the same thing. I'm seeing some models that have come out a year, maybe a year and a half ago, still on shelves right now. What is their plan to not only move through inventory, but also for the stores that are underperforming and not profitable, make sure that they're kind of identifying where there needs to be a significant shift in the amount of overhead they're putting out there and the expenses in square footage operated and the inventory that goes into those new experiences?
Yeah, so look, they did say that the merchandise margin pressure and the gross margin pressure will continue into Q1. So essentially saying that, now in the early part of 2024, you'll continue to see that discounting to move on from inventory. As far as underperforming stores go, I mean, look, like this company has been a net store closer for as long as I can remember. I think every year since 2007, I believe. Like if you don't include acquisitions that they've made, they've been a net closer of stores. So they're continually pruning the store fleet and kind of saying, okay, yeah, we want to be a little bit more prudent, with the size of the store fleet and having, fewer but bigger and more productive doors. I think it's the right thing to do, but it does cause some near-term pain.
Speaking of that near-term pain, Janine, what is Mary Dillon not doing that she should be doing in order to better advance this turnaround?
We actually really like her playbook. I think she's doing all of the right things, but she's been dealt a tough deck of cards. And I think the thing that we struggle with this story is that a lot of this is in her control, but there's a huge piece of this turnaround that's not within her control. And that comes down to what the overall athletic footwear market does and then what the brands themselves do. And the elephant in the room right now is Nike, which they've taken down their exposure to Nike, but it's still 60% of their business. Nike's going through challenges right now where they're really suffering from a lack of innovation. So at the end of the day, she can do all of these things. And I think that there's a lot of low-hanging fruit, but you're still kind of subject to the overall demand for the brands that they carry and where the consumer is in the broader landscape.
Do they need more Uggs up in Foot Locker, Janine? I mean, it sounds like that's performing well for Deckers, company that's just gotten into the S&P 500.
Yeah, I mean, look, Uggs were great for them. Uggs were great for anyone who had them in stock over the holiday season. We are buy rated on Deckers and love that story, but that's not their core competency. What they really do well is athletic footwear, particularly basketball. Certainly Uggs will help them a little bit in the meantime, but that's not going to be the long-term solution for them.
And then just lastly, Tom, I mean, we're just weeks away from Air Max Day. I mean, when you think about big promotions like that are unveiling new innovation from companies like Nike or Adidas. Adidas has some huge announcements this year as well. All of these things considered, how much does that innovation at the manufacturer level move the needle for a retailer like Foot Locker?
Oh, I think it matters a lot. I look back to when Nike really was humming from an innovation standpoint, and I think about some of the Air Maxes that came out before COVID. I think about the Vapor Max, which came out I believe it was Air Max Day 2017, the Air Max 270, which came out on Air Max Day 2018. Those were home runs for Nike, and obviously Foot Locker was a key part of that, and you did see better performance out of Foot Locker before the pandemic. So I think it'll be important to see more innovation out of Nike and kind of help alleviate some of the malaise in the sneaker market overall.